I want to show you something. Take $500,000 at 7% annual growth for 18 years. That becomes $1.97 million. Now the IRS calculation at age 73 uses a life expectancy factor of 26.5. That means $1.97 million divided by 26.5 equals $74,340. That is the part nobody shows clearly on screen. That is not optional income. That is forced taxable income. You can spend 40 years building your 401k, thinking you're doing everything right. Then one day the IRS says, start taking money out. Whether you need it or not. Whether it pushes your taxes higher or not. If you're 55, 60, or 65, this video is specifically for you, because the real decision is not what happens at 73. The real decision is what you do before 73. Today we're answering 4 questions. First, how does the RMD tax bomb get calculated? Second, why does one forced withdrawal create a full tax spiral? Third, how does it affect Social Security and Medicare premiums? And fourth, what 2 moves defuse it before it goes off? Most people see a big 401k balance and think, I'm safe. But before we get there, you need to understand the difference between retirement money you own and retirement money the IRS is waiting to tax. The RMD calculation nobody shows you. Required minimum distributions are the moment your retirement account turns into a tax bill. Here's the calculation. The IRS looks at your prior year-end retirement balance, then divides it by a life expectancy factor. At age 73, that factor is 26.5. So if your pre-tax 401k balance is $1.97 million, the math is $1,970,000 divided by 26.5 equals $74,340. That's $74,340 of taxable income before you choose to withdraw an extra dollar. It's taxable because traditional 401k contributions went in before tax. You received the deduction earlier. The IRS collects later. Now, $74,340 doesn't sound like a disaster if it were your only income. But retirees rarely have only one income source. You can have Social Security, a pension, dividends, rental income, part-time income. That's where the bomb starts ticking louder. Because the RMD doesn't come in alone. It stacks on top of everything else. It doesn't ask whether you need more income. It adds taxable income to the return. Now, here's where it gets interesting. The full tax spiral. The first layer is bracket creep. Imagine you already have $30,000 in Social Security. Then the RMD adds $74,340. Now your tax return shows over $100,000 of income before deductions, dividends, pensions, or other retirement cash flow. That forced income moves you closer to the next federal tax bracket. For some retirees, it pushes them into a higher bracket. The second layer is Social Security taxation. A lot of retirees think Social Security is tax-free. That's not how the formula works. Once provisional income crosses certain levels, up to 85% of Social Security becomes taxable. So a $74,340 RMD can cause more of your Social Security benefit to become taxable. You don't just pay tax on the RMD. You also expose more of your benefit to tax. One withdrawal creates tax on another income source. The third layer is IRMA, the Medicare premium trap. IRMA is an income-related surcharge on Medicare. If your income crosses the threshold, Medicare premiums rise, and we're not talking about small numbers. Depending on how far your income exceeds the threshold, IRMA can add $12,000 to $15,000 in extra Medicare costs per year. And because IRMA uses your tax return from 2 years earlier, the damage arrives later, when many retirees don't connect the cause. This is the chain reaction. RMD creates taxable income. Taxable income creates bracket creep. Bracket creep increases Social Security taxation. Higher income triggers Medicare premium surcharges. That is the full tax spiral. Most people stop here, but there's one more thing. The account keeps growing. At 73, your RMD starts. At 74, the life expectancy factor goes down. At 75, it goes down again. That means the IRS divisor gets smaller as you age, so the required percentage gets larger. A big 401k doesn't become easier to control later. It becomes harder. The window from 55 to 65. The best time to defuse the RMD bomb is before the IRS forces withdrawals. That window is usually between 55 and 65, and sometimes it stays open until retirement income begins. But because this is often the lowest tax period of your adult life, your wages may be lower. You may have retired early. Social Security may not have started. Medicare may not have started. RMDs definitely haven't started. That creates room. That room is called tax planning space. And the main tool is a Roth conversion. A Roth conversion means you intentionally move money from a traditional 401k or IRA into a Roth account. You pay tax now, but that money no longer sits inside the future RMD base. Once qualified rules are met, Roth growth is tax-free, and Roth accounts do not create lifetime RMDs for the original owner. Here's the real number. If you convert $100,000 per year for 5 years, that's $500,000 moved out of the pre-tax bucket. At age 73, using the 26.5 factor, $500,000 less in the pre-tax bucket means about $18,868 less in annual RMDs. That is not a one-year difference. That repeats through retirement. Less forced income means less bracket pressure, less Social Security taxation pressure, and less IRMA pressure. If you're in the 55 to 65 window, alike helps this reach more people in the same situation. The two moves that defuse it. Move number 1. Calculate your future RMD before you retire. Don't wait until the first RMD notice arrives. Take your current 401k balance, estimate growth, and project the account value at your RMD age. Then divide that future balance by the IRS factor. The question is not, how much do I have? The question is, how much taxable income will this account force onto my return? That one question changes the whole plan. Move number 2, fill the right tax bracket before RMDs begin. This does not mean convert everything. That creates a new tax problem. The guardrail is simple. Convert enough to use the tax bracket you're already in, without accidentally jumping into a bracket, Medicare, or filing trap that defeats the strategy. For some retirees, that means converting $25,000 a year. For others, it's $50,000. For larger balances, it can be $100,000 a year for several years. The right number depends on filing status, deductions, Social Security timing, pension income, state taxes, Medicare timing, and spousal income. This is why Roth conversion sizing matters more than Roth conversion hype. The goal is not to pay zero tax today. The goal is to stop tomorrow's forced income from controlling your retirement. What to do now? Here's your practical checklist. First, find your total pre-tax retirement balance. Include traditional 401k, traditional IRAs, SEP IRAs, simple IRAs, and old employer plans. Second, separate pre-tax money from Roth money. A $1 million retirement account is not really $1 million if most of it is taxable. Third, estimate the future RMD. Use the age 73 factor of 26.5 if that applies to you. If your RMD age is later, run that age too. The exact age changes the number, but the tax bomb remains. Fourth, test Roth conversions before year-end. Waiting until December creates pressure. Planning earlier gives you permission to choose the number instead of guessing. And fifth, don't look at the RMD alone. Look at the full stack: RMD, Social Security, pension, dividends, Medicare premiums, deductions, and filing status. That is the difference between a retirement income plan and a retirement tax surprise. Urgent but fixable. The RMD tax bomb is not that you saved too much. Saving is not the mistake. The mistake is putting every dollar into the same taxable bucket and assuming retirement will be simple later. A $74,340 forced withdrawal sounds like success until it pushes your income, your benefit taxation, your Medicare premiums, and your filing plan in the wrong direction. The good news is this bomb has a timer. If you're 55, 60, or 65, the timer hasn't hit 0. You still have the conversion window. You still have planning space. You still have guardrails. Model your own RMD time bomb in Empower's free tool, link in the description. Tools and resources related to this video are linked in the description and pinned in the comment below. Thanks for watching. I'll see you in the next one.